people hate on 9 to 5s, and obviously the whole
They
entrepreneur hustle life and all this.
Yeah.
But obviously doing a side hustle like we do is hard work.
It's
It's essentially a second full-time job. And also with a 9 to 5, it's quite stable. You get monthly income, so you can invest every month. You might get like a workplace pension with an employer match, so you can use that to invest every month as well. USDT, was it Terra Luna?
Yeah.
Which was like the 5th biggest crypto, and that went to zero.
Yeah.
Like KSI invested 3 mil, and he lost like 100% of his money overnight.
That's why he's doing his boxing matches.
A lot of investing is just about like mindset and psychology, and just understanding like crashes and corrections happen. Like on average, the market corrects, which is a 10% fall every 1 to 2 years, every 18 months on average. Fidelity, they done this study years ago, and they found out like the investors with the best returns were actually dead, because they hadn't been able to tinker with their portfolio. Whereas everyone trying to buy and sell, time the highs and lows, actually lost out to the investors that are dead and just left their money there.
About a year ago, I think we spoke about you building your portfolio to 40K. Has it grown since then?
Now it's roughly about 60K.
Whoa, what? So 20 grand increase?
Yeah, 20K, yeah.
Welcome to the Takeoff Experience, where I sit down with highly driven people to talk about their journey, their failures, and their successes. If you want to take off in your career, your business, your finances, or your mindset, then this podcast is for you. Welcome back to the Takeoff Experience. We've got a special guest, actually a returning guest in the building. This is our first actually in-person podcast together. So we've got Ryan. How are you doing today?
I'm not too bad. Thank you for having me on. Looking forward to being here in person this time.
Yeah, no. I'm happy that you have you here. And a fellow Arsenal fan, we were talking about like how good of a game it was. Yeah, top of the league. I mean, they're different. They're definitely different this season.
Yeah, not too many tough games yet, but we're looking decent. So a couple more signings before the end of the window. Yeah. Hopefully we can secure top 4.
Yeah, you know what's interesting, right? Like even when we were like 1-0 down, it was so weird. I wasn't that worried. I was like, we look good.
The atmosphere, because I go to the games as well, and the atmosphere was buzzing.
Yeah.
So the second we went 1-0 down, everyone's still getting behind the team.
Yeah.
Whereas a couple of years ago, go 1-0 down, people are booing. The atmosphere is bad. Whereas this season, it's the same as last season as well, but the atmosphere is definitely a lot better than it used to be.
Yeah. No, I really do appreciate it, and I get to watch my favorite team again. But just to remind those who have never listened to an episode with you before, who is Ryan?
Yeah, so I'm Ryan. I'm now 25 years old. I essentially work as an accountant in London and also live in South London at the moment. And then on the side, I have Making Money Simple, which is my financial education sort of platform where I share personal finance tips. The main aim is to get people to start investing. That's obviously how I met you and why I'm here. Yeah. And then it originally started off in 2019 as just like a blog, then started an Instagram, and then over time it sort of evolved to now where it's like a podcast, a YouTube channel, a TikTok. Try and do as much as possible to get the word out there.
Yeah, it's crazy. And yeah. I think you were one of the first pages I followed 2 years ago now. I don't remember how we connected, but yeah, I remember you were super consistent. You were posting valuable content, and it's so crazy like how the content's changed, because it was more like infographics and now it's like videos
it's a lot more
tweets. Yeah, it's changed a lot. But no, you were the one thing that you definitely have been so consistent on is pushing index funds and the fact that you're transparent with what you invest. I think that's why you have got a lot of people following you and engaging with you, because you're fully transparent with all your investments. And as we both know with investing, right, it's not like a path up. It's not just up. Sometimes it's down, and you show that as well, which I think a lot of people appreciate. But like, I think we had our podcast episode like a year ago. So what's changed since that time?
I mean, so since then, back then I was living in East London.
Okay.
Now
really?
Now I'm in South London.
Okay. Why?
Clapham.
Oh, Clapham. Classic. Oh, nice area.
Yeah. This time last year, I think I also had just finished my accounting exams. Yeah. So now I'm like officially a qualified chartered accountant, which is good. So that's more personal side. On the Making Money Simple side, I got monetized on YouTube actually at the start of this year, I think it was, / end of last year.
Fantastic.
So not earning much money, but the odd 20-30 quid a month is better than nothing.
It's better than nothing. I mean, if you get one video that's viral, at least you'll get paid for it, right? Yeah.
And all the old videos are monetized, so they get paid going forward as well. So all the content that I made before isn't like wasted. Yeah. And then, just as you were saying, like trying to post weekly podcasts, YouTube videos, Instagram posts, all that sort of stuff is sort of the same as it was a year ago.
Yeah. Wow. That's crazy. What an achievement. And what you thinking, over the next year? What's going to happen? What's going to be different?
I'm moving to Australia.
Okay.
Which I've not actually really said much before. So
Okay.
I've got an exclusive.
Yeah, thank you. So why haven't you said anything about it like online?
So it's because I'm always worried it's eventually going to fall through. I don't think it will at this point. I've signed contracts and stuff, so I'll be going with my employer doing a 3-year secondment.
Yeah.
I think close to the time, my plan is to start tweeting about it. I also want to know like the best current accounts, best credit cards, best investment accounts. I need to research all of that. So when I go over there, I can obviously
find out all the financial influences in Australia. Isn't it one that we both follow? I think actually
there's a few. There's like Investor Queenie.
Yeah.
There's another guy called Blake who I think's fire with a family.
Okay.
There's another guy called Ollie. I can't think of his app, but there's a few Aussies who I'll DM and see if they can help me out.
You know what? It's going to be really interesting from your perspective because you're coming at it from a complete different perspective. You're coming at it from here, the UK.
Yeah.
It's going to be interesting to see what it's like out there. Like, is the system the same? Is it slightly different?
Yeah, I'm going to be interested to see actually just what their culture's like in terms of money.
Yeah.
Because here is very much like you get a house as soon as possible. You then rely on your pension, and that is essentially it.
Yeah.
Even now, I think 3% of people have a stocks and shares ISA.
Yeah,
and the average stocks and shares ISA pot is only £9,000.
Yeah.
So you think about it, that's hardly anyone, and in a tiny pot of the people that do have it. So I'll be interested to see if I feel like Americans are more money focused than
way
us.
more. Yeah.
So I want to see where the Aussies are in between us and America. I'll be interested to see.
You know what? There's a really popular podcast called Girls That Invest.
Yes,
and I'm
I follow
pretty
them
sure
as well.
that they're from Australia. Yes, I have a feeling that they might be, but again, it'll be interesting to see what that's like. So do you know what you're gonna whereabouts in Australia?
Melbourne.
I don't know much about it.
Yeah. It's sort of, and I don't know much about Australia, but it seems to be like the sort of sport capital of Australia. They got the Grand Prix, they got the tennis, they got golf, they got obviously Aussie rules, football, rugby, cricket. So be a lot of sport to watch would be good. I'm looking forward most to going to the Melbourne Grand Prix, hopefully in April 2023. But yeah, be going to sporting events.
Wow, you're gonna actually try and go to it?
Yeah.
Wow, that's mad.
All 3 days, hopefully.
That is crazy.
I've got to try and make some friends, first of all, that I can go to these things with, but I'm sure it'll be all right.
I'm sure you'll be fine. I mean, you're a sociable guy. And you know there's financial influences there, and I'm sure that they'll be happy to welcome you, and then you can give us a little bit of an insight of what it's out there. So I wanted to know, so about a year ago, I think we spoke about you building your portfolio to 40K. Has it grown since then?
Now it's roughly about 60K.
Whoa, what? So 20 grand increase?
Yeah, 20K, yeah.
That's insane. Is that because of why is that?
So it's largely due to my own contributions.
Okay.
Obviously, if anyone's been investing really this year, they sort of know it's been, the last month's been all right actually, but generally speaking, the markets like the S&P 500, the global sort of indexes and funds are still down year to date over the last sort of 8-9 months. But really, I've just been focusing on investing as much as possible. Yeah. So since October last year, when I qualified as the chartered accountant and got a big pay rise, I've been putting $650 into my stock and shares ISA every single month. And then my workplace pension, which is 6%, and my employer matches it. So that's like 12% of my salary going into my workplace pension every month. I also recently opened up a SIP with Vanguard, maybe like 4 months ago. I've been putting £400 a month into that.
Why did you open that?
Essentially, I can't withdraw money from my company, Making Money Simple, tax efficiently. Because a salary, my marginal tax rate is quite high. And in dividends, I can take 2K. But after that, I pay like once again a higher tax rate. Okay. So then the third way you can withdraw money is essentially by paying it into a pension. So it's sort of, I can't obviously access that money for like 35 odd years. Yeah. But it's still sort of in my name, and I can then like have it growing over the next sort of 20, 30 years rather than just sitting in cash in my like business bank account doing nothing. And then other than those three is then crypto, which I'm still sort of investing regularly into, maybe like between sort of £30 and £100 a month, probably average around 60, bit of Bitcoin, bit of Ethereum, which we can come on to. But yeah, essentially, mainly through my own contributions is how that's grown. But I think that's an important point, because I think when it comes to investing, a lot of people think you're going to invest and then after like a few months, or even a few years, you're going to have loads of money. But ultimately, even in the first decade, the most important things are just your own contributions and getting as much money invested as possible, because then that's then going to grow and snowball and compound over the decades to come. So almost, I'm at the point now where I've been investing for 5 years as well, so it's not happened overnight, But now I'm on a decent salary, got like a workplace pension, got obviously my side hustle, making money simple, which makes money. So now I can actually sort of contribute a decent amount every month. And I've got that sort of base now where over the last 5 years, even though I did have to stop investing, my wealth would hopefully still compound pretty steadily over the next sort of 20 years.
Yeah.
But obviously the plan is to carry on, invest as much as possible, and then eventually be financially free.
I was going to ask you, is that the ultimate goal, to become financially free? Is
Yeah.
that why you're investing so aggressively?
Yeah, I think like the more medium term goal is to do making money simple full time.
Okay.
I know quite a few people in the UK actually. Some of our friends do like their sort of finance influencer thing full time. And there's quite a few people in America that I know that do it as well.
Yeah.
I don't really earn anywhere near enough money at the moment between my different like things to do it full time. But I reckon if I could build up to a point where I earn like a decent amount of money, I could then do this full time. And then the long term goal would essentially be to build my investment pot up so that I can live off of that money.
Yeah.
And then still do making money simple though, because I enjoy it, but not work like a 9-to-5 corporate job. Even though I imagine I will be doing that probably for a good, like at least 5 to 10 years.
Yeah.
But people hate on 9-to-5s, and obviously the whole
They
like
do,
entrepreneur hustle life and all this.
Yeah.
But obviously doing a side hustle like we do is hard work.
It is, yeah.
It's essentially a second full-time job.
It is, yeah.
And also with a 9-to-5, it's quite stable. You get monthly income, so you can invest every month. You might get like a workplace pension with an employer match, so you can use that to invest every month as well. So there are pros and cons. So yeah, I'll carry on doing this for now, and then hopefully one day do making money simple full time.
Yeah.
And then one day be financially independent and free.
Yeah. You know what is crazy? I like the idea that you are long-term thinking. I think a lot of people are very quick to just start a business and just quit their job, but you've got like a clear plan of how you want to do things, and you don't actually mind, okay, if I'm going to be in a 9-to-5, let me take advantage of their benefits, which is pension. Like, you know, the pension is such a big benefit that I think people don't realize until when it comes to when you need it later on in your life. I mean, saying to somebody that will give you 6% of your salary for free.
Yeah, you're literally getting 100% return on your own money for complete free.
Yeah.
You're then also avoiding some income tax because you contribute to a pension out of your gross salary, which then means you have more money compounding over the next 20-30 years. So of course you have to pay tax in the end. The first 25% but then you eventually pay tax after the first 25%, which is tax free. But still, you get free money from your employer. You then have their free money and a sort of tax relief money that you've got by contributing gross, all compounding for decades to come. Which is why you hear some people years ago who didn't even contribute to a pension, hardly anything, they now have hundreds of thousands of pounds just because of that sort of 40-year time period where you start work at 20, finish at 60, and then you have a sort of nice surprise, which hopefully I'll have a good surprise when it comes to live off of it one day.
No, it's I think all of this stuff is just about thinking long term. You know, I always say to people, even myself, right, like I want to do Savvy Wallet full time, but I'm not in a rush. I want it to get to a point where it's like quite organic. It's sure that it's going to make a steady amount of income, right? And it's not spiking up, it's not spiking down. It's steady. It's growing organically to the point where it does that. And I think that you have the same mindset, but at the same time, you're still going on adventures. I mean, you're going to Australia regardless, right? So it's not like you're stuck in one place. You're still willing to. So how are you gonna try and manage all of that? The transition to Australia, you're making money simple.
Yes, it's going to be tough. I think it'll be quite good at the start because all the new things I can learn, I can obviously share with like, I mean, even though most of my audience is from the UK, hopefully they'll be interested and like it.
I'm sure they will be. People want to know what like people are getting up to in another country. Yeah.
But I mean, it's a 10 to 11 hour time difference, I think. So it will be tough in terms of posting. I'll have to probably schedule posts maybe like very early, maybe very late at night, and then sort of when I wake up, then reply to comments and DMs and stuff. And I'll definitely try and make it work, but I guess I might be slightly less active if I'm sort of trying to enjoy myself and have fun whilst I'm out there as well. But I'm living in London, and it's obviously, as you know, very social and busy, and I've generally made it work most of the time over the last sort of 3 years now. So hopefully Australia will be the same, and just all things going the sort of same, posting daily on like Instagram, TikTok, and then posting weekly on YouTube and trying to do podcast episodes and that sort of thing.
Yeah, I'm looking forward to seeing how it goes. Let me know. You got a long flight though to get there. 2 flights, 3 flights. So as you mentioned before, the stock market has not had a great year. This year is recovered a bit. but at one point, I think it was around May, it was really bad. Everybody was running away.
I think like at one point the Nasdaq, which is the largest 100 US tech stocks, was down like 35%.
Yeah.
The S&P 500 was down 25%. Global markets were down like 20%. So I think Bitcoin and Ethereum were down like 50 odd percent from all-time highs.
Down
so
as well, quite a bit. It's,
a lot of things took a pounding.
A lot of things took a pounding, and the kind of conversations I was having with people, a lot of people was thinking nuclear warfare was going to happen, and I was saying, no way. I was like, it's not going to happen. I was like, that doesn't, I get the fear and where that comes from, but I just didn't think that. Why would you want to kill yourself?
Yeah,
it's just,
we had the war, like inflation, now interest rates rising. So sort of everything that's going wrong. Even though unemployment's really low, obviously economically people focus a lot on inflation and interest rates, and that's what's ultimately driven this, and that all then stems from like Brexit, COVID, the war in Europe, and it also contributes to a bad sentiment, and ultimately it's the negative sentiment or positive sentiment that drives the market.
How did you deal with the stock market during that time? Like, what convinced you to be like, I'm going to continue investing regardless?
So I literally did nothing different, and the thing is, those times when there is absolute turmoil, so things like world wars or like the dot-com crash or like 9/11 or like the 2008 financial crash, those, or COVID when it first happened in March 2020, those like terrible events are often when the stock market drops the most and are the best times to invest. Because if you look at, if you're investing in sort of like a broad fund, so like the US stock market, the S&P 500, the global stock market, that's the FTSE All World or the FTSE Global All Cap, those sort of funds have hundreds, if not thousands of companies. And if you look at a chart over their sort of period for 10, 20, 50 years, they always steadily go up over time. Of course, they're going to be negatively impacted where there are these bad events, but companies always sort of bounce back. Humans always bounce back, which is why, as we're going to get onto, I prefer using index funds and not individual stocks, because individual stocks can fail. But I literally done nothing different. I mean, if anything, I probably should have tried to invest more because there were like some very bad lows, but I just continued investing as normal. Most of my investments are automatic, so the money just flows into it from my sort of account or from my salary each month. And I just carried on as usual, carried on investing. And now since then, everything's sort of a bit more back in the green now because the markets have bounced back sort of since June.
That's epic. And I think that's is a really important message for people to understand that actually the best time when it comes to investing is when everything's on discount. Just like in real life, right? When things are on discount, that's when you want to buy stuff. So it's this exact same thing with investing.
The thing is as well, you can't time the lows. So what I was saying there was like, I should have invested more, but just say I did invest more because the market was down 10% in March. It could have then dropped another 20% or 50%. No one knows. Like all these economists make predictions that are very rarely right. And if they were right even once, they would just put all of their money at the low and then sell it at the high and then never work again. They get most of their predictions wrong. All of the bankers at the Bank of England and these inflation people get all of their predictions wrong, and they're on like hundreds of thousands of pounds a year. But which is why the best thing to do is literally set up an automatic payment and just stick to it whether the market's falling or rising. Of course, if the market does drop, 30% in a month and you have an extra £100 you can invest, it's probably going to do well, but it's not to say the market could not drop further after that 30%. So I just think investing automatically, regularly, the same amount sort of each month, and then increasing that amount as your salary goes up over time is what I've done over the last 5 years. And I think it's pretty much the best way to just invest because it takes the emotion out of it, takes all market timing out of it. You're just sort of being consistent, and then your wealth will grow slowly over time. And you invest yourself in a global, is it just one global index fund now? Essentially. So my stocks and shares ISA and my SIP, which is probably over half my portfolio, probably about £35,000, is all in, or maybe £30,000 actually, somewhere around there, is all in the FTSE Global All Cap, which is a Vanguard global index fund. It essentially invests into 7,000 stocks all around the world. It's still dominated by US stocks because how it works is it's like weighted to each country in the proportion that they make up of the stock market. So the US stock market makes up about 57% of the global stock market. So the FTSE Global All Cap has 57% US stocks. UK makes up about 4% of the global stock market. So the FTSE Global All Cap has 4% UK stocks. And it's almost like proportionally weighted and efficient. And as different countries grow and contract, And as different companies fail and succeed, that's then reflected in the global fund. And then, my wealth has sort of grown steadily with that over time.
Yeah.
But it's a FTSE Global All Cap. And in my workplace pension, I don't have that fund available, but I once again essentially chose the lowest global fund that I could find.
Yeah.
And that is, I'm not sure what it's called actually, but that's just once again a low cost global fund. So I
Yeah.
think depending on what platform or account you're using, there might be different options. That my approach is generally the most globally diversified for the lowest fee. And then you're not betting on any individual company or industry or economy. You're just betting on the world growing over time, like it always has done for the last thousands of years.
You're betting on just generally the world growing rather than trying to figure out what country is going to be the best over the next 10 to 20 years. What industry is going to be the best over the next 20 years. You're just saying, let me just invest in globally the world economy as a whole, that we think that it will go up. It makes sense, right? Because it has in the past. And that's your investment strategy.
So I've done a lot of
that makes sense.
Because I wrote an ebook actually, which came out end of last year. But as part of that, I did a lot of research in like the last 100+ years of global stock market returns. And what you see is one country is very rarely dominant for more than like a couple of decades. So, for example, the UK was about 25% of the global stock market 100 years ago. Now it's only 4%. So if 100 years ago you thought the UK is the biggest and best economy, I'm only going to invest in that. Of course, comparatively, it's hardly grown compared to the rest of the world. Japan is probably the best example, because in the 80s and 90s, it was every investor's favorite economy. All the best car companies, tech companies were all in Japan. And Japan made up about 45% of the global stock market.
Wow.
And now it's only 6%. And there's hardly been any growth in Japan for decades. The US is a bit of an outlier, but over the last 100 years, its sort of low point was about 15% of the global stock market, and then its high point was 65%, and it's now at 57%. But it's sort of been the biggest economy now for about 15 years, and as I was saying, you very rarely see one country be so dominant for sort of 30, 40 years. So it could be emerging markets growing now, could be China coming soon. Like, no one really knows, which is why I don't just want to bet on the US, even though it's currently doing the best. Because who knows in 20 or 30 years' time what the world might look like. And you sort of got to keep your ego in check and understand that you can't predict which economies can do the best. Everyone thought Japan would be the best 30 years ago, and now they're tiny compared to the US in terms of their like output and their like market cap, what they make up of the global stock market. So that's essentially why I use global index funds, try and take all the emotion out of it, look at the data, and then just invest based on that.
And I think that makes sense. And I think I would say pretty much everybody should have like their base anyway, or their portfolio should invest in a globally diverse index fund or ETF. I think that makes sense.
Yeah, I agree.
To have as a base, especially when like you're a beginner investor, I think like your first 5 to 10,000 should be in something like that. And then if you do want to dabble up, maybe like if you're a stock nerd and you're like, okay, cool, I really want to dabble into other stuff, you can, but you have that as a basis, because like you said, it makes sense. Nobody's going to be able to predict what happens. Like, the States has been the best, but a lot of people are saying that it's overvalued and it may not return that well in the next 10 years. Nobody knows, right?
Literally no one knows.
No one knows. They're saying, okay, in the future it might be the second biggest and China might be the biggest, or it might be the third biggest, and you're having to do all these calculations and on variables that you do not control at the end of the day, right?
Literally no one knows, which is why it's just and it's much more simpler as well. Just accept that, and then for me personally anyway, use one global fund primarily, and then that's all I've got to do. I've not got to be like researching individual stocks. And I used to do that, to be fair, when I first started. When I was at uni, had a lot of time, I'd always be like reading up at different stocks, watching YouTube videos. But I sort of understood, even from doing that for like a few months, it's just impossible to predict what the market's going to do. No one knows. So whilst I'm still interested in individual stocks, I literally don't invest into hardly any. And like on my stock market investments, like 98% or something is in index funds and ETFs.
Okay. Wow.
So I've
8%.
Literally
That's
no individual
crazy.
stocks pretty much.
Oh my gosh. So what is there any other index funds you invested in?
So it's mainly
the global one. And
so I've got the FTSE Global All Cap on Vanguard
Yeah.
in my ISA and my SIP. On free trade, I've got another. They don't have the FTSE Global All Cap,
Okay.
but they have the FTSE All World,
Okay.
which is also on Vanguard's website. But I have that on free trade. Essentially, I had some money on free trade, and I wanted to put it in a global index fund, and the FTSE All World is the best option. It's essentially the same as the FTSE Global All Cap, but it doesn't invest into small cap stocks.
Okay.
So it only invests into medium and large size companies,
Right. Okay.
which actually means it has half the amount of stocks than the FTSE Global All Cap.
Okay.
The All Cap has 7,000. The All World has 3,500.
Right.
But if you actually look at the performance over the last 10, 15 years, it's literally identical.
Okay.
Just because the small cap stocks are a relatively small part of the All Cap.
Okay.
And they don't really contribute a huge amount. So it's literally the exact same performance. So that's a question I get quite often. They say, like, I watch your Vanguard portfolio updates and you have the FTSE Global All Cap on my platform or in my country. I don't have that. What should I do?
Yeah.
And I just say, look at the FTSE All World, because it's essentially the exact same thing, like a globally diversified Vanguard fund. On Trading 212, I then actually do have the VUSA, which is the S&P 500 ETF.
All right. Okay.
To be honest with you, that has been there now for years. It's like maybe like £1,000 I've just had. It's almost like a legacy position at this point. I probably should just either put it in a global fund or take the money off the platform and put it into my ISA. But I quite like opening up new investment accounts of new platforms just to like try them out. And when people ask me, like, what do you think of like this X new platform? I already have an account, so I can like tell them what it's like and what are the pros and cons. So that's on Trading 212. And I've also got then my stake platform, which is like an Australian platform. And you essentially, I have individual stocks on that platform, only like 500 quid, but that's essentially because you can't invest into ETFs unless you're an accredited investor. So I literally have I literally cannot physically. I wanted to invest into global ETFs.
Isn't it supposed to be the opposite?
Yeah, I don't know. yeah. Well, that's how it used to be anyway, like maybe a year or two ago. I don't really use it much. But yeah, so I have like $500 on there, split between like Tesla, Coinbase, and Nike, I think. I mean, like, I very rarely check it, but yeah, that's essentially like my whole portfolio.
Okay. Wow.
But yeah, as I was saying, like 98% of the money is in index funds or ETFs.
Yeah.
Of that, like 90% is in global index funds and ETFs. About 8% is in the S&P 500, and then the other 1 or 2% is then just sort of some random individual stocks on stake that I physically can't put into index funds. Otherwise I would, and then they wouldn't exist.
Yeah. You're definitely protected. Your portfolio, even with the swings in the market, your portfolio is definitely protected because it's so diverse. Even when it's going down, it's not going down as much as like a stock like a Tesla or something. $1,000 to $800. You're not losing 20% in like a week or a few days. So yeah, I think that is one of the biggest benefits of investing in index funds and ETFs, because I feel like it's a bit better for your emotions.
Yeah, definitely.
It's definitely better for your emotions, especially as a beginner investor. You're not going to see yourself losing loads of money overnight or over a few days, and your downside is a lot more protected. You're also investing in crypto as well,
so the one thing that's pretty sudden, actually, one misconception, I guess, of index funds and ETFs is people think because they're really diversified, they can only go up. You can still lose. You can still lose money if there's like a war, like there is and was. Like the global index funds will still be negatively impacted. But using that example earlier on, the Nasdaq at the start in the first 6 months of this year, or the first 4 months of this year, fell about 35%, whereas global funds only fell about sort of 17-18%. So it's one of those things where you still will lose money, but the point is, because you're globally diversified, if one company does fail, like like Blockbuster or Woolworths or whoever, if someone runs out of money, you're not going to lose 100% of your money because you have, in like a global funds case, 6,999 other stocks to sort of help you stay afloat.
Exactly.
But yeah, no, I do also invest in crypto.
Yeah.
So I've been doing that pretty regularly since about May 2020.
Okay.
So it's been probably like maybe like nearly 2.5 years now. Essentially just read like a few books in terms of crypto, and then sort of believed in it and sort of started investing into it pretty regularly. And that was actually when like Bitcoin was less than $10,000 and Ethereum was like $200. Yeah. So I wasn't even that early, but compared to what the prices got to, where it was like 60k and 4k, it looks early. But that's just the nature of crypto. That's even more volatile than anything else. I think it's a good point what we made earlier on, because I did have pretty much a solid base even before that.
Yeah.
I'd been investing really since like indirectly through my workplace pension in 2017 and then directly through my stocks and shares ISA in 2018. So I did still have about three sort of years of sort of a base of like index funds and ETFs and sort of knowledge and reading and making money simple and everything. So and then I eventually took the plunge and started investing into crypto in like May 2020.
Yeah, I said 5 to 10K, but how much do you think somebody should have invested in like a well, again, I think diversified portfolio. So I think a global index fund, like you said, or ETF.
Yeah.
How much do you think somebody should invest?
It's hard
have
to
as a base. I know it's different for different people, but
it's
as a
hard
base
to put a
before they
number.
start looking at crypto.
It's hard to put a number on it. I'd say probably look at it more as like a percentage.
Okay.
I'd probably say you probably don't really want more than 20 to 30% in crypto.
Yeah.
Particularly if you're a new investor, maybe even 10%, just because it is very volatile. Like you can almost see ridiculous returns overnight and then it will all come crashing down the next night. But I'd say maybe like a maximum of 30% in crypto, between 10 and 30%. So if you have, maybe like £900 in an index fund, maybe put £100 in crypto. But you got to understand that it's very volatile and is much more volatile than the stock market. Yeah. Of course, you can make more money, but you can also lose more money, which is why, a bit like with my stock market approach, and I keep my strategy as simple as possible, my crypto approach I also keep as simple as possible. So I pretty much only invest into Bitcoin and Ethereum.
Okay.
They're my main two positions in my portfolio. So ultimately, my thinking is that, crypto has only been an asset class since about 2008, 2009. Yeah. So it's only been around for about 13 years. And it's impossible to know if it will actually survive. Yeah. If it will be around in 50 years, 100 years, 500 years. No one knows. So I think if any are going to survive, it's going to be the big ones being Bitcoin and Ethereum, which is why, I mainly only invest into those two. I've got a bit of CRO. Which is crypto.com's token. Okay. But that's because I'm just like a big fan of their platform. I've got their prepaid card. Okay. I use their staking feature. I use their sort of like platform to buy crypto. So I have a bit of CRO, but the main two I like actively invest into is Bitcoin and Ethereum every month. Okay.
And I think that makes sense. They have a history of being the top two for quite a while. Bitcoin's been the top for 10 plus years.
Bitcoin's always been the top. And I think even, I don't know right now, but Bitcoin, I think, makes up like 50+% of the total crypto capitalization or market cap. So the total value of crypto, more than half of it is in Bitcoin, which was the first mover. It was been around for the longest. Yeah. It's obviously got the properties where, the blockchain where people first saw it. So, and then Ethereum was sort of the next biggest one. And that's, I guess, like with crypto, sort of more like a digital gold, a store of wealth, whereas crypto is sort of, with Ethereum, you can use for like actual purposes, like I guess like buying NFTs and art, for like lending. That is more of like a use case and sort of utility to be used. And that was once again like a first mover, which is probably why it's the second largest.
Yeah. I think I understand definitely why people are bullish on Bitcoin and Ethereum for the long term. I think there's nothing out there yet that can say, okay, I've got the reputation of Bitcoin. Yeah. I've been
nothing ever will, I don't think either. Yeah.
Not even Ethereum, Bitcoin is the godfather. Doesn't mean the godfather can't get taken down. It could potentially, but like I said, there's nothing yet in terms of the trust. I don't think there's any other crypto out there that has the same level of trust as Bitcoin or Ethereum at the top. That's why they're the top. Yeah. Because institutions trust them. The rest, they don't really trust them.
And that's what caused a massive boom in 2021. A lot of like institutional investors, a lot of banks, a lot of hedge funds all started investing, or the whales, as people call them, like the big investors, the big purchasers, started buying up Bitcoin, which is why its price shot up to like 60 or 70K or something crazy. But almost similar to my sort of stock market portfolio. It's not like I don't enjoy looking at individual cryptocurrencies. I still watch a lot of YouTube videos on crypto and new cryptos and stuff, but ultimately I just like my strategy being as simple as possible, which is why I just stick to Bitcoin and Ethereum. I don't want to be tracking 50 different coins and all of that stuff, Bitcoin and Ethereum, and that's what I've done for 2.5 years now, and will continue to do.
Yeah, and I think it makes sense. There's like, I think it's 9,000 coins or something. 9,000 coins / tokens out there. There's always
what's this for?
Crypto 9,000.
Oh, Jesus.
Yeah. There's like 9,000. Yeah, it
That's
just keeps
mad.
on. You know, because there's no regulation, so anybody can create their
Yeah.
own scams and
Yeah,
rubbish, and you know,
which is
like
even
90%
more
of
so.
it is a mess.
The whole thing with what was it? The other USDT, was it Terra Luna?
Yeah,
Which was like the 5th biggest crypto, and that went to zero.
Yeah,
Like KSI invested 3 mil, and he lost like 100% of his money overnight.
that's why he's doing his boxing matches.
Yeah, easy to.
I see you, KSI. Yeah, that's why he's doing them boxing matches two in one night. But
so that's it, and that was like I think the 5th or 6th biggest crypto, which sort of shows you even the biggest ones can fail. I mean, Bitcoin. I mean, maybe not Bitcoin. Ethereum probably still could still fail.
Yeah,
because with Bitcoin, there's not like a team or like an owner necessarily. It's just sort of proof of work. So you have miners all sort of validating the blockchain, the people investing into it. It's sort of completely decentralized, whereas a lot of other cryptos do have some sort of centralization.
Yeah,
which is
some
why
kind of founder,
Yeah.
some kind of person that is tied to it.
So even though people do represent Bitcoin and the Bitcoin network, I do think that's the true decentralized coin. And that is why I think that one will always be the biggest and the best.
It's just was a disruptor, and because, like you said, nobody claims it.
Yeah.
Said I created it. I mean, okay, there's one person in the world that's trying to
no one knows who he is.
Yeah. But trying to claim right now. The guy in Australia is actually, or was it New Zealand?
Yeah, in Australia.
He's trying to claim that he's a creator. I mean, I'm not gonna dispute whether he is or not.
I might meet him when I go there.
Yeah, you can speak to him. Maybe get on the podcast. That is jokes. So you invest in Vanguard. Is that still your preferred platform?
Yeah.
At the moment? Yeah. Okay.
Yeah. I mainly use, so I have my workplace, my SIP, which is my private pension, and my stocks and shares ISA with Vanguard. Yeah. I've been using them since about mid 2018. So for over 4 years now, which is actually pretty mad. I mean, there's loads of reasons why I use Vanguard. So first of all, they're the second largest asset manager in the world behind BlackRock. Okay. So in terms of sort of like having a good reputation, being reputable, being safe, trusting them, you can't really get much sort of bigger than that. They have like trillions and trillions of dollars under management, and they have a pretty low fee, or very low fee actually. There are lower fee options, like Invest Engine is a new platform which is sort of almost trying to become the new sort of Vanguard, but they're very low fees still, and they're also transparent with their fees, which is what I like. If you just type in on Google Vanguard full costs and charges, you can see exactly what fees you will pay for every single fund you can invest into, like to the 0.01%. Whereas on other platforms, particularly when you're sort of buying individual stocks, it can be a bit of a minefield. Like you have like an FX fee, then you have like a reinvesting dividend fee, then you have a platform fee and an annual charge fee, and then stamp duty, and then like the bid-ask spread, the price between the buy and the sell price. It's almost a bit of how much you're actually paying in fees. You're probably paying a lot of hidden fees you don't even know about. Whereas Vanguard are very transparent. So that's number 2. Number 3, they only have funds. There's no individual stocks on the platform. So it really fits my sort of like passive investing long-term approach of just buying and holding index funds over the long term. And then number 4 is they have my specific global index fund that I use, the FTSE Global All Cap. And that's 100% of the money that I've got in my SIP and my stocks and shares ISA. I mean, number 5, I guess. So Jack Bogle, who's the founder of Vanguard, he actually created the first index fund in 1975 and also created Vanguard, which brought down fees massively, because before that, really, it was only sort of rich old white men who invested in the 70s. It was only available to them. Now, literally anyone can invest for literally peanuts, and it's mainly because crazy, of him innovating
wealth that you can, that you can create out of it. Like you said, like it's crazy, like how accessible it is today. Like, and I feel like it's become way more accessible in the last 2 years. We've seen so much progress. I remember literally it was about, I think it might have been the beginning of 2020 when I wanted to invest in stocks in the US. And the only options at that time was, I think, like Hargreaves Lansdowne
Yeah,
was the only one.
and that's an expensive
Yeah,
platform.
it was quite expensive. And
Yeah.
these other ones came out, like the Trading 212,
Yeah.
the free trades. Now you spoke about what was the one that
Stake.
Yeah, Stake, and
got, like,
there's all these other ones that have come out now. By the way, not investment advice. Just talking about the progress. And now they allow you access to it with low fee. So it's
it's never been more like cheaper, easier,
Yeah.
and accessible to start investing.
Exactly.
I mean, with Vanguard, the minimum amount per month is £100.
Yeah.
So it's still like a decent amount of money.
Yeah.
But if you can't afford that, there are some of the platforms you mentioned. You can actually start from like £1, £3.
Yeah.
So you can still start even if you only put £5, £10 in a month.
Yeah.
Which
crazy.
you couldn't have done, as you were saying, a few years ago, let alone in the 70s when like Jack Bogle sort of created Vanguard, an index fund, and then obviously the industry was fuming with him because they were ripping people off, charging massive fees, and he's here like, I got the S&P 500, tiny fee. We get better returns than all of you fund managers.
Yeah, they're still ripping people off, to be honest.
There are,
right? Because if they charge you, I don't know what their charges are, but let's say they're charging you 3% a year, which is probably what they're charging, right? That's a crazy amount, right? You know, and inflation is what, 2%. So they're charging you more than inflation, so you're wiping out that much of your money every year. Like it's crazy. Yeah, it's crazy. It's
like they rip people off because people really, and it's a lot through like things like pension funds where people almost don't know any better and don't check what they're being invested into. Then all of a sudden, and it's even like a 1% fee. It sounds like 1%. You know, that's hardly anything. Like if you invest £100 a year, it's only £1. But all of a sudden, if you compound, say, £100 a month for 30 years at say 10%, and then you change that to 9%, that 1% fee you're paying, that will literally put thousands, if not tens of thousands of pounds back into your pocket had you sort of reduced that fee earlier on. Which is why, generally speaking, the lowest fee option, the better in terms of both platform and the actual fund you're invested into. Just because the lower fee you pay, the more money is compounding in your pocket, and then the more you'll end up with in the end. It's and crazy. Even like 0.5%, 1%, some of these like rip-off funds charging 2-3%, like that will literally take hundreds of thousands of pounds out of your pocket and put it into the fund manager's pocket. And often with these active funds, you're essentially overpaying for underperformance. And that has been proved like time and time again. Every year when the data comes out, it's like 85% of fund managers underperform their benchmark, or 95% underperformed. And if you literally just use a global index fund or an S&P 500 index fund, you're going to outperform most professional people who do it for a living, which is crazy to think about, because pretty much everything in life, the more you do of something, the better you're going to get. So people often think, if I like research loads of stocks and do all this intricate like sort of digging, I'm then going to get a better return. But often you won't. Which, like, another thing is Fidelity, they done this study years ago, and they found out like the investors with the best returns were actually dead because they hadn't been able to tinker with their portfolio. Whereas everyone trying to buy and sell, time the highs and lows, actually lost out to the investors that are dead and just left their money there.
Wow.
Which sort of just shows why buying and holding, investing regularly isn't only the simplest strategy, but, and obviously I'm biased, but in my opinion, the best strategy, just because like the data over the last 100 years, as we've been through history of looking at sort of all these active fund managers, it's just impossible to consistently beat the market, and it's literally one of the hardest things to do in the world.
Yeah, it is. It really is. And like we said, so many variables, and as we get more and more information, those variables become even more extreme of how things are going to happen, right? Like I remember so vividly the beginning of this year in January. You know, I've been in the stock market, predictions. There was not one prediction about any war happening in Ukraine.
Black Swan event.
Nobody ever thought that was happening. You know, so there's so many things, like so many things happening in a few months. So we had Ukraine issue, petrol prices went crazy. Inflation was kind of going, but it was not that bad.
Obviously the government,
energy
the government just like falling apart.
Just like in the space of just a few months, like for the first 2 or 3 months, it's like, how much is going on, right? You know, mad. People boycotting Russia, like a lot had happened. So this is the stuff that you've got to try and predict on a day-to-day basis globally.
Which why it's so difficult.
Insane. It's insane. So
I mean, even I think like Warren Buffett, who's like the greatest investor of all time, has, I think, like only just tracked the S&P 500 over the last 10 or 15 years.
Yeah.
So even like the best investor of all time, who has like billions of dollars and reads 500 pages a day and literally knows all these CEOs personally, can't beat a simple local S&P 500 index fund. Like, what chance do we have working 9 to 5 and doing like 20 minutes of research a night?
It's tough. It definitely is tough. So for those people, because we probably will have another Black Swan event in the future. We don't know how the year is going to end. It could end badly. You know, we're hearing our energy prices are going to skyrocket. So that could have an impact across the world. We don't know. I know in the UK's energy prices are bad. I don't know what it's like in the US. Maybe it's equally as bad. There might be a recession. There's lots of talks and stuff like that. So it's likely the stock market could go down, right? A lot of people are going to be scared. So what would your tips be to those people who are going to be worried about investing in the stock market at a bad time?
So I think, as we sort of went through earlier on, investing those bad times are actually the best times to invest. I mean, this sounds a bit stupid. And if you just start investing recently, you're probably not going to think like this. But I would almost wish the stock market would crash like 80% and then stay low for years and years, so I can just carry on investing at super low prices and then make even more gains over the future. Of course, I know that's selfish, because if it did do that, a lot of people who would be retiring next year would be like crippled. So, and I'm sure that won't happen because of all the money printed and the governments would intervene and stuff. But I would just say a lot of investing is just about like mindset and psychology and just understanding like crashes and corrections happen. Like on average, the market corrects, which is a 10% fall every 1 to 2 years. Every 18 months on average, the stock market crashes, which I think is a 20% fall every sort of 6 to 7 years. So these crashes and corrections are just completely normal. There's always booms and busts. So you always got to try and get your head in a place where you're happy, well, not happy, but you can deal with yourself losing money on paper. And remember, it's only on paper until you sell. If the market crashes 20%, and you don't sell, you've not actually lost any money. It's only on paper.
Exactly.
And the market, as we've shown with COVID, as we've shown with the Ukraine war, as we've shown with the dot-com bubble, the 9/11, the financial crash in 2008, the Wall Street crash in 1929, all the oil shocks and crashes in the 70s and 80s, the market always bounces back, which is why just carry on investing and carry on holding is the best thing to do through those bad times. And which is why I think just sort of getting a good grounding on just like psychologically, like the mindset sort of side of things. There's a good book called The Psychology of Money, which I'd recommend people read, which is a pretty short read, like 200 pages, and sort of goes through a lot of that behavioral economic stuff. The Little Book of Common Sense Investing is Jack Bogle's book, going through sort of index funds and investing for the long term. That's another good book to read. And that's sort of books to read when maybe you're feeling a bit nervous with the market falling. I mean, another thing that goes without saying, only invest what you can afford. You still actually, any money you're investing, you shouldn't be touching for 10 years at a minimum, probably even more. Ultimately, with me, when I'm investing money, the main aim of that money is literally to live off of it one day. So I don't want to be touching it. And even then, I'll only be drawing down a little bit of it to live off of. So only invest what you can afford. Obviously, you need to have like an emergency fund so you can like survive any emergencies. You need to have some money in your like current account so you can survive and live day to day. So don't YOLO 100% into the stock market and then it crashes. You got to be sensible. But yeah, that's probably the two main things I'd say. Just have like, as I sort of went through, have like a good sort of financial base. If you can have like an emergency fund, focus on paying off high interest debt. So then if a crash did happen, you're then sort of like got a good financial base that you don't need to sell your investments. Yeah. And if anything, when it does crash, you actually want to add to your investments if you can, because that's the best time to invest. Yeah. Or at least carry on investing. And then at the same point, being sort of grounded in like the psychological side of things, to understand that this is normal. This happens all the time. It's part of the economic cycle. There's booms and busts. It's nothing new. If you're 20 years old now, you will probably go through pretty much at least 20 corrections. Yeah. We'll probably go through at least 3, 4, 5, 6 huge recessions where people are losing jobs and there's like 30, 40, 50% falls. That's just the nature of investing. And yeah, something you've got to sort of deal with. Yeah. Great
tips there. Really love that. And I had a question actually from a few people in terms of like beginning their investing journeys. What would you say is the best way to start? Because there's a lot of information out there. There's almost too much to consume. So
Yeah.
where would you say is the best starting point for someone to begin
Choice
their investing
overload.
journey?
So I'd say the best thing to do is probably read a few books.
Yeah.
So I'd say some good books are Rich Dad Poor Dad.
Yeah.
I mentioned 2 already: Psychology of Money, Little Bit of Common Sense Investing. Another couple of good ones are I Will Teach You to Be Rich.
Yeah.
I always have 5 that I come out of. I've forgotten the 5th one, but I'd say just reading a few books, get a sort of good understanding of investing, of like the mindset of wealth building or personal finance. And if you sort of read those 4 books I mentioned, you'll be quite well rounded when it comes to sort of managing your money.
Yeah.
And then I think ultimately the most important thing is just to get started. And that's why, shameless plug, my ebook.
Plug it.
Stop waiting, start investing.
Yeah.
And it essentially goes through the 3-step process that I've talked about for years on Instagram and YouTube and podcast, which essentially you choose a platform, choose an account, and then choose an actual investment. So for me, that looks like choosing the platform, Vanguard, choosing an account, a stocks and shares ISA or a SIP. For me, I'd probably say a stocks and shares ISA, just because that's more flexible and you can live off of it before retirement age. And then 3, choosing actual investment. For me, that's a global fund, specifically the FTSE Global All Cap. And then the minimum amount is £100 a month on Vanguard. Set up that investment, and then you're literally an investor into 7,000 stocks. And then sort of what will happen is, though, as you sort of learn more and like read more, you might change your strategy. You might maybe have a few individual stocks. You might want to invest into some REITs to get some property exposure. You might want to invest into crypto. It will evolve and change. But I think just by getting started and following that 3-step approach, you got very low fees. You're globally diversified.
Mm-hmm.
You're investing every month automatically as well.
Yeah.
So you're then sort of almost you're literally 95% of the way there.
Yeah.
And then anything extra you do is really just tinkering with it.
Yeah. Brilliant.
So that's how I'd say to get started. And that's what I talk about in the ebook, on YouTube videos.
Yeah.
Like even I send voice notes pretty much weekly to people when they ask me how to start. I might just do those 3 things. And they're universal no matter what country.
Yeah.
There's platforms in every country.
Yeah.
Their accounts might vary, but you can almost follow like low fee platform, a sort of account with some tax advantages, and then a global fund. And then you're literally like 90% of the way there.
Yeah. Brilliant tips. And I always appreciate your approach to making it as simple as possible for people, because when I started,
it's a lot
I didn't understand it like that. I was like, okay, I want to invest, but what do I invest in? I didn't even really know about the stock market. I was like, okay, cool, what's the stock market? Okay, how do I invest in the stock market? Okay, platform, okay, account, okay. There was like so much. So I really appreciate the way you break it down. It's going to be very, very helpful for the listeners. So yeah, what's next for you?
So obviously, as we discussed at the start, Australia. So I'm moving out of London in about a month, and then I'm going to Australia the following month in October. So really, it's probably going to be, I guess, like winding down and getting myself ready for that. Yeah. And then hopefully learning about all the Australian personal finance things that I can share on Instagram and TikTok and all that. And then whilst I'm there, I'll be sort of like working a 9 to 5. I'll hopefully still be posting content on Making Money Simple, and I'll sort of be trying to like enjoy myself and going to sporting events and going on nights out and traveling around Australia and all that sort of stuff on holidays. So that's the main thing. I think in terms of Making Money Simple, the next thing I want to do, other than sort of posting like consistently on all the different social media platforms, is maybe make a course.
Okay.
Yeah, I've done a poll a couple of months ago, and I've been a bit lazy with it. If people, because I've sort of done like a spreadsheet, I've done a workshop, I've done a book. I'm like, what can I sort of do next? And I've done a poll. Should I do like a course, a video course, or like a mastermind group of like people where you like pay monthly and we're all in the same group and do like weekly calls and stuff? And people said the course. So I think I'm going to sort of maybe build a course based, because I've done so much stuff on investing and that 3-step approach already. Yeah. Even though we'll go through all of that stuff, it's more going to be like personal finance focused. Okay. So going through like saving, like getting married, how to deal with that, buying a house, how to deal with that, buying a car. Coming to you with some tips. But all these actual like personal financy things like saving, budgeting, and then of course investing as well. But they're sort of going from like even like investing for children, like how to like pass money down and avoid inheritance tax. There's loads of sort of things you can cover. And I think I want it to be more like a well-rounded overview of personal finances. So I know people, even though I do read a lot, I know people don't like reading. And most courses focus on one individual specific thing. Whereas I think if I do like it might be quite long, but I can do like a broad course. That maybe I'll bring it out.
Do it in different modules.
Different modules, Maybe I'll bring that out at some point this year. I've not already got too far of it, but Maybe I'll do that.
Yeah. Let us know. Therefore, watch out for that. I'm sure a lot of people appreciate that, because a lot of people need guidance in terms of their personal finance. It took me years to get to this stage, and I would have definitely appreciated some sort of guidance, you know.
And it's never perfect. You're always learning,
exactly,
reading, adapting it.
Exactly.
Obviously, as new accounts come out, you might switch to get a high interest rate, or switch credit cards, or switch platforms. So it's always sort of evolving.
Yeah, it's crazy. I'm still learning things till today. I mean, for me now is transitioning to, you know, getting joint accounts, learning what that process is like, and it's very, very interesting. Where can people find you?
So pretty much making money simple. On every platform, like Instagram, TikTok, Twitter, YouTube, the podcast. If you pretty much go on any platform, just type in Making Money Simple, you'll probably find me. There are actually a lot of fake accounts.
Oh my God, your Instagram. I searched
it's
for
crazy.
Making Money Simple. You've got at least 6-7 fake accounts.
It's ridiculous. So it's literally Making Money Simple, all one word. That's it. There's no like apostrophes or commas or dots or underscores or double Y's or double. It's just literally Making Money Simple. And I'll obviously never ask you to your like personal details.
I can vouch for Ryan. He'll never ask you for that. Yeah, that's crazy.
So just be careful. But yeah, Making Money Simple on every platform pretty much.
Wow, awesome. And do you have a final word for the listeners or watchers?
Yeah, stop waiting and start investing.
Bars. No, thank you so much, Ryan.
No, thanks for having me on. I appreciate it.
Coming in person.
Yeah.
You know, it's always great speaking to you about investing, and you always give like great actionable and straightforward tips, and you don't speak in a jargon. You don't speak with a lot of jargon, which I really appreciate, and a lot of the listeners would appreciate. I think, you know, sometimes when you speak to people, you forget like the wealth of knowledge you've accumulated, especially in a personal finance space. So it can become really easy to say things in you know, with jargons and try and use all these really smart, intelligent terms, and then you just bamboozle them. But you've kept it simple, and you've been consistent. So I want to definitely commend you on that.
One thing we'll say as well, if anyone does have any questions, they can DM me on Instagram. Obviously my real account, not the fake ones. And I'll either like try and help you out or sort of point you in the right direction, or someone who knows more than me. But no, I appreciate all those kind words.
No, it's all right. I always have to appreciate somebody who's been in the game for longer than me as well, especially. No, definitely appreciate you. Good luck in Australia. Let us know how it goes, and when you come back, we'll definitely do a podcast. If the podcast's still going, it probably will be. When you come back in a few years' time, then we'll do it. And you can tell me all about what it's like investing in Australia, personal finance in Australia. That'd be awesome. Listeners, thank you so much, or watchers, thank you so much for tuning into this episode of the Takeoff Experience, and we'll see you next week.